Okay, hi guys. Hi there, everyone. I am doing this recorded lecture for chapter 5 of our accounting for payroll textbook or payroll accounting textbook. And so in chapter 5, we're getting into unemployment taxes. So federal unemployment tax, state unemployment tax, commonly known as FUTA and SUTA, respectively. And so we're going to look at those and look at some examples of calculating those, and of course, get practice with this in class together. And so I am going to share my screen with you and get the PowerPoint pulled up. And of course, I'll get this PowerPoint posted so you guys have access to this as well. But again, chapter 5, we're getting into unemployment compensation taxes. And so unemployment compensation, as you already, probably already know, refers to any compensation that we can receive or that an individual can receive if they become unemployed, right? And so your book, according to our textbook, unemployed person includes young people seeking positions for the first time, seasonal workers unemployed a part of each year, and workers who lost their jobs through various causes and cannot find other suitable employment. So that's what how your chapter defines unemployed persons. And again, when we think about unemployment tax, right? So the government funds the unemployment program through unemployment taxes, both federal unemployment tax or FUTA, FUTA, or state unemployment tax or SUTA, SUTA. So we're going to learn more about that. And then again, look at some examples and some of these different things here in the chapter. All right, so learning objectives of this chapter describe the basic requirements for an individual to be classified as an employer or an employee under the Federal Unemployment Tax Act. And basically it kind of goes just like we've read before. This is kind of based on that common law idea of, if an employer pays wages of 1,500 or more during any calendar quarter, employs more than one person in each of 20 or more calendar weeks during the year. So we've kind of talked about some of these things before. And so it's just kind of, reviewing that a little bit, what we've talked about, similar to FICA, what we talked about in chapter 3. Identify generally what is defined as taxable wages by the Federal Unemployment Tax Act, that's FUTA. Compute the federal unemployment tax, the credits against the tax, and any credit reductions that might apply. Describe how an experience rating system is used in determining employers' contributions to state unemployment compensation funds. Complete the reports required by Federal Unemployment Tax Act. Describe the types of information reports under the various unemployment compensation laws. So some of the things, again, that we're going to be looking at going through this chapter. All right, so FUTA and SUTA, again, FUTA, Federal Unemployment Tax Act, just like it shows here, passed to fund unemployment compensation program as ordered by the Social Security Act of 1935. Federal law that imposes a tax on employers based on wages paid for covered employment. And as we're going to see, so the federal wage limit, 7,000. So basically employers pay unemployment tax on up to 7,000 of wages. After 7,000 of wages, they do not have to pay unemployment tax on that employee any longer. Funds collected by this tax used to pay the cost of administration of federal and state unemployment insurance programs. All right, so that's FUTA. And then SUTA, State Unemployment Tax Act. So each state has a trust fund financed by state unemployment taxes. All the states, Puerto Rico, the Virgin Islands, and the District of Columbia have enacted unemployment compensation laws approved by the Social Security Administration. Benefits are paid as per each state's unemployment tax laws. And we're going to see as we go through, and I forget, I want to say it's on chapter or not chapter, but page chapter 5, page 13 or 14, and we're going to get there as we're going through our PowerPoint slide, but it shows each state's basically wage limit and unemployment tax rates and maximum benefits paid out if an individual becomes unemployed and so forth, right? It shows that to us in the book. Okay, coverage under the Federal Unemployment Tax Act. So employers are liable to pay tax if either of the following two tests applies. And so the first test pays wages of, and I mentioned this earlier, pays wages of $1,500 or more during any calendar quarter in current or preceding calendar year, or employs one or more persons on at least some portion of one day in each of 20 or more calendar weeks in current or preceding taxable year. Employees include regular, part-time, and temporary workers and individuals on vacation or sick leave. Special rules for agricultural and household employees. And so it talks about this, really the bottom of page 2, chapter 5. Agricultural employees who in the present or previous year paid, agricultural employers, excuse me, who in the present or previous year paid $20,000 or more to farm workers in any calendar year and or employed 10 or more farm workers during some part of a day during any 20 different weeks. This includes wages paid to aliens who are in this country on a temporary basis to perform farm work. And then for the household employer, a household employer who during the present or previous year paid $1,000 or more during any quarter for household services in a private home, college club, or local fraternity or sorority club. All right. All right, so employees covered under the Federal Unemployment Tax Act. The general rule is an individual is considered an employee if common law relationship exists, and I mentioned this earlier. So if the employer has the right to direct and control the employee's activities, that's, you know, that common law relationship, right, relates to that common law relationship. If the employer has the right to direct and control the employee's activities. So you have to be here at this time, you get off at this time, while you're here, you need to do this type thing, that type of relationship, right? Also specifically includes drivers who distribute food, beverage, or deliver laundry, and then traveling salespeople in certain situations. As we've learned before, in some situations, salespeople, like with real estate agents, for example, are considered independent contractors. But in some situations, a traveling or city salesperson engaged in full-time soliciting and transmitting to the principal orders for merchandise for resale or supplies used in business operations. So, specific exceptions include casual laborers, partners and directors, foreign students and exchange visitors, students enrolled full-time in an internship program, independent contractors, home workers, full-time life insurance salespeople, government employees of international organizations such as United Nations. And it does show a complete list on page 3 and 4. And so there's several other ones here, like for example, number 12, services performed by individuals in fishing and related activities if the vessel is less than 10 net tons. Services performed by employees or employee representatives for employers covered by either the Railroad Retirement Tax Act or the Railroad Unemployment Insurance Act, right? So there's several of them, 16 different ones that they talk about on page 3 and page 4. Okay, coverage under SUTA, which again is the State Unemployment Tax Act, right? So the employers in general, employers specifically excluded under federal law are also excluded under state laws. That's not always the case, but in general, if it's some business that's excluded under federal unemployment, then it would also be excluded under state unemployment. And so when you think about people that are self-employed or independent contractors, right, they do not have to pay unemployment taxes on themselves, right? So there are some exemptions or some individuals that are excluded, right? Employees, so employees generally covered under state unemployment. If covered under federal unemployment, minor variations exist in state laws. Many states apply the ABC test to determine exclusion from state unemployment tax coverage. All of the following tests must be met. So the worker is free from control or direction. The work performed outside usual course of business. The worker is customarily engaged in an independent trade or business. All right, interstate employees and state unemployment tax. So interstate employees are employees that work in multiple states. So just like it shows here, to prevent duplicate contributions on the services of interstate employees, their coverage is decided by applying these rules in this order. So the state unemployment taxes can be paid in the state where the work is localized, if that is such a thing, or at the location of the base of operations, again, if that is a specific state. Location of place from which operations are directed or controlled, or in some circumstances, location of the employee's residence state, are some ways that those can be applied. All right. Reciprocal arrangements, like your book tells us, many states, I want to say, and actually, so here it shows 5 states and Puerto Rico do not participate. So, basically 50 states, or 45 rather, out of 50, participate in this type of reciprocal arrangement. So interstate reciprocal coverage arrangement may be applied if, by applying the order in the previous slide, coverage of interstate employees cannot be determined. So if really they don't have a home office, or, they don't have a good base to, base of operations, or place from which operations are directed, or, even a good place, I guess, that they can't determine the employee's residence, which seems weird. They can sign one of these reciprocal coverage arrangements. And so states enter into arrangements under which the employer may elect coverage of the employee in one state. The benefit to employer is that they can choose the state in which all services of interstate workers are to be covered. And then they can base it on, just like it shows here, the most advantageous wage base and contribution rate. So, for example, looking at your book, and I'm going to get the page pulled up. I want to say, okay, so it's page 13 and 14. Okay. So looking in your book, like for example, Illinois, their rate goes up to 6.875%. And that is on 12,960 of wages, right? Missouri, where's Missouri? Missouri goes up to 5.4%, and that's on 12,000 of wages, right? So So if a company chose to sign into one of these interstate reciprocal coverage arrangements, they might be inclined to choose Missouri because Missouri has a lower unemployment rate, basically, right? A lower wage base and a lower unemployment rate, basically. But just like it shows here, once the employer chooses and employee consents, the state approves the election of the coverage. If the employer is transferred to another state during the same calendar year, wages covered by unemployment compensation law of previous state are included by employer to determine the taxable wage base. Let me get this off of here. Okay. All right, so for Americans working overseas, they are still covered by the Unemployment Tax Act. So U.S. citizens working abroad for American employers are covered. State of employer's principal place of business provides coverage. If principal place of business cannot be determined, state of coverage is the state of incorporation or the owner's state of residence. To qualify for benefits, claimants must have earned a minimum base period wage, which is 40 times the weekly benefit or 2,500, whichever is greater. And then be able to meet some of the other requirements that may be established by the state. Like I know in Missouri, you have to be, you know, able and available to work. You have to be actively looking for work, and you have to serve a 1 week waiting period. Now, myself, I've never applied for unemployment benefits, but I know a few people that have over the years. And, you know, I think like Missouri makes sure that you fill out like 3 applications a week, or you have to like view 3 job openings or job positions a week or something. I forget exactly what it is, but every state kind of has its own little rules or whatever where that's concerned. Okay, taxable wages for the Federal Unemployment Tax Act. So taxable FUTA wage base includes the first 7,000 of wages. And so we'll be using that number, the first 7,000 of wages. And again, a state might go up to 12,000, like we saw with Missouri. Missouri's base equals 12,000. So for state unemployment in Missouri, you have to pay on wages of up to 12,000, right? But for federal, it's 7,000 is the maximum. So basically, an employer has to pay unemployment taxes on up to 7,000 of wages for an employee. After that employee is over, you know, their ending cumulative earnings are over 7,000, they no longer have to pay, the employer no longer has to pay unemployment tax on that employee, right? So wages include not only what an individual is makes per hour or is salaried, but also bonuses, advances, commissions, transfer of stock by employer to employee as remuneration for services. As we already know, the fair market value is what is used for the wage expense or the taxable base. Tips reported by the employee to the employer, retroactive wage increases. And again, it shows us a more detailed list of this on starting on page 7. You know, advance payments for work to be done in the future, cash and non-cash prizes and awards for doing outstanding work, exceeding sales quotas or contributing suggestions that increase productivity or efficiency. They've got all different they got 17 different ones listed here. Christmas gifts excluding non-cash gifts of nominal value. Commissions, okay, we already talked about that. Contributions by an employer to a supplemental unemployment individual account plan. Dismissal payments or severance pay, idle time and standby payment, right? There's several of them listed that you can see. And then also some of the non-taxable wages are listed there as well. So, all right. And then just like it shows here, if employee has more than one employer in a year, wage base applies separately to each of those employers. Okay, wages exempt from FUTA. Again, these are all shown on page 8, chapter 5, page 8. There are several of them shown, 13 different ones are shown on page 8. Here are a few of them here. Advances or reimbursement of business expenses, retirement pay, educational assistance payments, meals and lodging furnished to an employee if for employer's benefit, strike benefits paid by union to its members, workers' compensation payments, reimbursement of an employee's moving expenses. It says if at the time of payment, it is reasonable to believe that the employee will be entitled to a deduction for those expenses when they file their tax return. Courtesy discounts to employees and their families, caddy fees, allowances made to an individual by a prospective employer for expenses incurred in connection with interviews for possible employment. I remember when I was first doing my interview at William Woods, my very first in-person interview at William Woods. I remember they told me I could have filled out some kind of form and got reimbursed for gas mileage. I was like, no, it's okay. I'm not worried about it. But it just made me think about that, you know, allowances for expenses incurred in connection with interviews. But anyway, the list is on page 8 if you would like to read further on that. Okay, so federal unemployment rate, so 6% of the first 7,000 of gross wages for each employee per year. However, a company is given a credit of 5.4% against FUTA for their SUTA taxes. And this 5.4% credit is allowed, and that's what it's telling us here, right? This is allowed even if the experience rating of the company allows the employer to pay lower than 5.4% in their state. So the actual net FUTA rate is 0.6%, right? That's the 6% minus 5.4% credit, and so 0.6%, yeah? Okay, because companies get that credit, you know, even if their state, you know, they pay a lower rate than that in their state, they still get that credit, so, okay. Okay, so here's an example, and this is actually an example that I just typed into the slide out of your book so we could look at it together. This is shown on, this is on page 10 of your textbook. And so this one says, well, you know, 5-10, right? Chapter 5, page 10. So this one says, during 2019, an employer had charged the wages account for $79,850. So this is our total wages, right? 79,850. Of this amount, 720 will not be paid until the first payday in 2020. So just like it tells us in our book, we only pay unemployment tax on wages that have actually been paid. And they use the term constructively paid. Wages are considered paid when actually paid or when constructively paid. Wages are considered constructively paid when credited to the account of or set apart for an employee so that they may be drawn upon at any time, even though they are not actually, even though the funds are not actually possessed by the employee. So basically, you know, we've given the employee the paycheck, the funds are set aside. It's been constructively paid type deal, right? So we do not pay unemployment taxes until the wages have been constructively paid. So we're going to end up having to subtract this out, right? We're going to have to subtract that 720 out. And we see that down here. Will not be paid until the first payday in 2020. Further, the wages actually paid to employees in this year in excess of 7,000 each amount to 29,840. So again, of this 79,850, 29,840 were over the wage limit. Over the wage limit, right? So we're going to have to subtract those out. We're going to have to subtract those out too. Okay, so that's what it's showing us down here. We take the total amount charged to wages. We subtract out the wages not paid till 2020. We subtract out the wages that are above the limit. So we're subtracting out basically 30,560. So total taxable wages, 49,290. And then we multiply by 6%. We get the amount of gross FUTA tax, $2,957.40. Remember, that's gross FUTA tax. That's at that rate of 6%. But remember, companies get that 5.4% credit, right? So 6%, and then we're going to minus this 5.4% credit. So our net FUTA rate, 0.6%. So based on those taxable wages, 49,290, multiplying by the net FUTA rate, 0.6%, the amount that we'd actually have to pay FUTA taxes, $95.74. Okay. All right, credits against FUTA tax. So we've talked about this a couple times here already. This is that 5.4%. So to get the full 5.4% SUTA credit, employer must have made state unemployment tax contributions on or before the due date for filing. So once they are late on their unemployment tax payments, then they start getting penalized basically. So if contribution is not made on a timely basis, credit is limited to 90% of the tax. Even if employer pays into more than one state unemployment compensation fund, credit against federal tax still limited to 5.4%. Some states have a higher wage base than the federal amount. We talked about this with Missouri and Illinois, for example. Now, in 2019, Missouri's was 12,000 was the wage limit for unemployment. But actually in 2020, Missouri's went down to 11,500. They adjusted that down 11,500. But anyway, in our book, it shows the 2019 stuff. So it shows the 12,000, but it is actually 11,500 right now. But anyway, so in such states, SUTA contribution may exceed 5.4% of 7,000 FUTA. Maximum credit is limited to 5.4% of the first 7,000 of each employee's earnings. Also, to obtain maximum credit of 5.4% against FUTA, the employer should not be located in a state that defaults in its repayment of Title 12 advances. So Title 12 advances, and it's going to show us this, or the next couple bullet points talk about this a little bit, but Title 12 advances are basically when a state had to borrow from the federal government to cover unemployment compensation, and they're not repaying it on a timely basis, basically. So Title 12 of the Social Security Acts lends funds from the federal government to states so they may provide unemployment compensation funds. And so if they do not pay these funds back in a timely manner within a year, so after 1 year, credit is reduced by 0.3% per year, beginning the second year after the advance. Additional credit reductions for the benefit cost ratio possible, beginning with the third or fourth consecutive year in which the federal loan is not repaid. So basically, they start getting penalized beginning in the second year after the advance. So if it's not paid off in the first, right? Okay, SUTA laws and rates. So different laws in different states regarding wages determination for SUTA, right? Every state has its own laws, so every state's going to be a little bit different. The most variations or the most common variations are in defining taxable wages and then the treatment of dismissal payments or severance payments. Taxable state unemployment wage-based caps at different amounts in each state. Again, we talked about Missouri and Illinois, but just looking at pages, and I'm turning to them here, pages 513 and 514, for example, in Massachusetts, the wage limit is 15,000. And they can go up to 14.37%. Let's see, in Alaska, it's up to, the wage base is up to 39,900. In Hawaii, it's up to 46,800, right? So every state is different, but you can look at those states in the book if you'd like more on that. All states have enacted pooled fund laws. The cost of unemployment benefits spread among all employers in the state. Again, figure 5-1, which we've read off of a couple times, pages 5-13, 5-14, summarize all the states' SUTA wage limitations and tax rates per state. New employers pay an initial contribution rate that applies for a specific time period. Usually, this is a low rate. Like I know it says in your book, like, for example, Oklahoma's like, 1.5%, or another state is 2% or whatever, but it cannot be less than, not less than 1%. But it's usually a low rate, 1%, 1.5%, 2% or whatever. It just cannot be less than 1%. And so they let these new employers pay this initial contribution rate while the employer is developing a little bit of an employment record, right? Because when they go to determine how much an unemployment tax an employer has to pay, the employer's experience and like turnover, employee turnover, and how many employees have filed for unemployment, for example, right? That all plays into how the business, or how much the business has to pay in unemployment taxes, right? Some states impose a contribution requirement on employees in addition to employers. So the general rule is that only employers pay unemployment, right? But what it's showing here is that some states do impose an amount that employees have to contribute as well. So, okay. SUTA laws and rates. So experience rating reflects stability of employers' employment history. Lower employee turnover is reflected in lower state unemployment tax rate. Most common formula is the reserve ratio formula, and I'm going to write that formula on here. It is in our book. For some reason, they don't put it in the slide, but this reserve ratio formula. This is, okay, so reserve ratio. Okay, this is on page 16, by the way. These are the contributions. So that's the money that the employer paid in to the unemployment contributions minus any benefits paid to unemployed workers divided by average payroll. And this is actually a 3-year average normally. Right? So rate is determined by computing total reserve built up by employer contributions over a period of time. So the reserve is the difference between the contributions and the benefits paid, right? So that's the numerator there, the reserve. And here I'll put that in parentheses. That's the reserve. That's the, hot dog. I'm not very good with this thing. The reserve. Right? The difference between the contributions and the benefits paid. B, computing ratio of reserve account or amount / employer's annual. Here, I guess they did write the formula here. Computing ratio of reserve account. And so that's the contributions minus the benefits paid, divided by, and that's where they have this slash here, employer's average annual payroll determined under the state's formula. So positive balance employers are employers that have more contributions than benefits paid, right? So contributions are greater than benefits paid out, right? This means that the employer has built up a balance in reserve. Negative balance employers, contributions are less than benefits paid, right? And negative balance employers will experience, of course, higher tax rates then in that case. So just like it shows here, some states reduce rates if employers make voluntary contributions to state fund. And the reason is because, again, this reserve ratio, the higher our reserve ratio, the lower our tax rate, right? So those have an inverse relationship. So the higher the reserve rate, lower the tax rate, right? And it does show this to us, bottom of page 16, right? This formula is at the top of page 16. At the bottom of page 16, they show us this reserve rate, this tax rates, they have an inverse relationship. So the higher the reserve rate, the lower the tax rate, right? So if we make voluntary contributions right here, and we increase the numerator, then that's going to increase the reserve ratio, which then may lead us to a lower tax rate, right? So it says this increases reserve account and thereby lowers future SUTA rate. Employers determine the amount of voluntary contribution necessary to obtain a lower contribution rate. Sorry, I was taking a drink of my chocolate milk. Okay. Terminating liability, an employer remains liable for 2 years. To terminate liability, an employer must file application by the date set by the state's laws. And I was just going here. This is talked about bottom of page 18, top of page 19. It says the employer's liability will end as of January 1 of any year if during the preceding year the employer did not employ the required number of employees for the required time or did not have the dollar amount of payroll necessary to be covered. In most states, coverage can not be terminated if the employer is subject to FUTA. So if they're subject to federal unemployment, they're going to be subject to state unemployment, basically. And then here it says federal law states that nonprofits have the option to reimburse the state for actual amount of unemployment benefits paid instead of paying percentage for state unemployment taxes. So this is kind of in the situation where they're like self-insuring, basically, right? They're self-insuring. They're going to pay the benefits on their own instead of paying into the state fund. And then the State Unemployment Tax Act Dumping Prevention Act requires states to enact laws to stop businesses from lowering their unemployment rates by forming new companies with lower new unemployment tax rates and then transferring employees into new companies. So the whole dumping is that you're dumping the original company's high tax rates. So, okay, anyway. All right, so here it shows us an example. It says, Sumatra Imports LLC, based in New Mexico, has a SUTA. Let's do this real quick. Well, it's given us the information. I was going to say we could look it up on page 13 or page 14, but okay. Has a SUTA tax rate of 4.2% with a taxable SUTA wage base of $24,200 for each employee's earnings. During the year, Sumatra had FUTA taxable wages of $109,500 and SUTA taxable wages of $298,700. Compute the amount of net FUTA tax and net SUTA tax, assuming they are not located in a state with a reduced credit. This is from that Title 12. If they had defaulted on payments back to the federal government or whatever, they'd have that reduced credit. But so if they do not have the reduced credit, we take that 109,500 times 0.006, that's 0.6%. So FUTA taxes the employer, right? The employer pays $657 to federal unemployment. And then for SUTA at 4.2%, then the employer pays $12,000, right? This is also employer pays $12,545.40. Okay. All right, filing the annual FUTA return, the form 940. And I actually have one, I think, saved maybe on the next slide, but the form 940 is due by January 31st of the next year. If timely deposits have been made, the company can have a 10-day extension, basically until February 10th to file. If they had, if they're a multi-state employment or had to pay unemployment taxes in multi-states, they'd have to fill out this Schedule A, and it does show us a copy of that in the book. Once filed with IRS Center for district in which principal place of business is located, IRS will send pre-addressed Form 940 near close of each subsequent calendar year. Can be granted extension of time to file return by the district director. However, this is not an extension of time to pay. So companies can have an extension to file the paperwork, but they can't have an extension to pay. They have to keep the unemployment tax up. When filing a corrected form, mark the amended box and include explanation as to why an amended return is filed. In the year company ceases doing business, a final return must be completed and the balance of tax paid. Employers can electronically file through the payroll service provider or the IRS web-based internet system. And we talked about this before, EFTPS, I think it was, EEF, I think is the EFTPS, which is the electronic maybe it's I think it's ETFS. Oh man, now I'm really gonna have to find it because I'm forgetting the electronic filing. Oh no, it is okay because it's okay. I just it's funny. Okay, EFT. Lord have mercy. Okay. Oh, I should be in bed, I guess. All right. Electronic filing tax payment system. I think is what it stands for. Now I'm gonna have to find it. in the book. Okay. Electronic federal tax payment system. See, I messed it up, but I had the, this is supposed to be federal. I had the acronym correctly. I had the acronym correct. Oh my goodness. Okay. All right. So Form 940 has multiple sections, and you know what, guys? It's actually set up very similar to the Form 941, right? So remember the Form 941, that form was for federal, let me hold my screen so it doesn't keep bobbing, federal income tax withheld, right? This was for the employees' FICA taxes withheld, and for the employers, because remember with FICA taxes, the employee pays a portion, the employer pays a portion, right? So the employer's FICA taxes withheld, right? That was what the Form 941 was. Now this 940, again, this is for unemployment taxes, right? And here I've got one so we can look at this, and I think what I'll have to do, let me click on this, and I think I'll have to, oop, hot dog. I think I will have to reshare my screen with you. I don't, hi guys, hello. Let me reshare my screen because I don't think it'll pull up since I opened a new window. All right, here's an example of what that looks like for 2020. The one in your book that they show us is for, I think 2019, but I did look at it. I didn't see any major changes from the one that they show in your book. So anyway, set up very similarly to the Form 941. And so you see all the employer information here. Oh, it won't let me. Here we go. Hold on. You know, all the employer information here, whether it's amended or if no payments were to employees, or it's the final, or it's a successor employer if the business was bought, whatever. You know, if we only had to pay unemployment tax in one state only, otherwise we got to check here and complete the Schedule A. This is the for multiple states. If you paid wages in a state that is subject to the credit reduction, again, that's that Title 12 that they talked about. All right, total payments to all employees. So, you know, this would match our total wages from the Form 941, right? This is our total wages. Any payments exempt from FUTA tax, total payments made to each employee, and then why they're exempt. So Part 4, payments exempt from FUTA tax. And again, some of these fringe benefits, group term life insurance, retirement pension, dependent care, other. And then we take 4 and 5, we add them together here for 6. And then we take 3 minus 6, and that's our total taxable FUTA wages here for line 7. And then we multiply line 7 by 0.006 or 0.6% to get our FUTA tax, right? And so Part 3, any adjustments, line 9 says if all the taxable FUTA wages you paid were excluded from state unemployment tax, multiply the line by 0.0454. If some of the taxable FUTA wages you paid were excluded from state unemployment tax, or you paid any state unemployment tax late, then that's where we got to move to the worksheet. We only get 90% of the credit. Credit reduction, if credit reduction applies, again, that's from that Title 12. Total FUTA tax after adjustments. FUTA tax deposited for the year. And then if there's a difference between 12 and 13, right? So if line 12, it's telling us right here, if line 12 is more than line 13, enter excess on line 14. That's what we owe, right? And if line 13 is more, so if we deposited more than line 12, this would be refunded to us, the overpayment. Okay, and then the last part of it, again, just like with the Form 941, we break it down per quarter. Total tax liability, part 6, if we may speak with a third party individual, and then sign here. And just because I'm fancy like that, there we go. Okay, anyway, I wanted to show you guys an example of what that looks like. I'm going to stop sharing that. Hello again. Okay, we're almost done here. Let me go back to my slideshow. Okay, and we went through each of these parts, so we're good with that, I think. Uh-oh. What do we got going on here? Okay, quarterly deposit. So deposit quarterly, but only if cumulatively over $500. So, you know, in quarter 1, if we've only got $100, in quarter 2, if we've only got $100, in quarter 3, if we've only got $100, we don't need to deposit quarterly unless it's over $500, cumulatively over $500. Employer must pay before the last day of the month following the end of the quarter. If 500 or less, employee can wait and add to next quarter. Employer can wait and add to next quarter. If employer's next quarter tax liability is 500 or more, they must deposit the tax liability before the last day of the month following the end of the quarter. So, for example, we are in quarter 1 right now, according to a calendar year, right? We're in quarter 1 right now, and quarter 1 ends March 31st. So then this would be due April 30th, right? The last day of the month following the end of the quarter. If tax liability never gets over 500, we pay with the Form 940 at the year end. Use payment voucher 940V and enclose it with check and the Form 940. Employers are subject to civil and criminal penalties for failing to file the 940 return, paying FUTA taxes when due, and making timely deposits. All right, some of these information reports, official form. So, you know, again, the Form 940, that's the federal form. So that's the federal form that every state has to use, right? But when we think about state unemployment forms, those are different for each state. And so that's what it shows here, is that official forms for filing SUTA reports vary widely by state. And I've got a couple of them pulled up here. So let me open these. I've got that one pulled up. Let me, hi guys, pull this one. Okay. So this is the Missouri Division of Employment Security Form 2699. And so this is what initially has to be filled out by the company so it says complete this form or register online at uinteract.labor.mo.gov. So company information, the type of organization, legal entity name, what type of business it is, you know, any of this information. Is this business a religious employer? Is it federally recognized as an Indian tribe? Is this business liable under the Federal Unemployment Tax Act in another state during the current or preceding calendar year? You know, several questions here. Is this a common paymaster employer? Does this corporation have or have they applied for nonprofit 503C exemption with Internal Revenue Service, right? So several questions here that we see, responsible party information, and then wages paid. So it's wanting us to put in the amount of wages paid in the current year, and it looks like 3 previous years, if applicable. And then also how many employees were employed each week. So these are the week endings, right? So January 6th, January 13th, 20th, 27th, right? Those are the week ending dates that we see there. Okay, so this is the one, you know, again, that we file initially with the Missouri Division of Employment Security. Let me leave this. I'm going to stop sharing that for a second. And I've got one more pulled up that I have on here for us to look at. Where am I at? And this one is actually when the Missouri taxes are being paid. So this is the quarterly contribution and wage report. EAU4 is the document number. And so you see employer name and address, number one, account number, the year, what quarter this is for, total wages paid in excess, taxable wages, you know, taxes due, right? If there's any interest assessment due, interest charges for the month if paid after a certain date, late report, penalty charges, outstanding amounts, total payment. And then it's asking for each month, enter the number of covered workers who worked or received pay for the period that includes the 12th of the month. So the first, second, and third period. The list of our employees, you know, name, social security number, total wages, and it actually shows us something like this. Let me find it now, probably because where is it at? It shows us something like this in your book on page 29, so 5-29, right? It shows us something like this. The one that they show us in the book is an example of Pennsylvania's. But again, since we live in Missouri, at least at this time we live in Missouri and are employed or going to school in Missouri, that's the one that I looked up, right? But you see that for each worker, and then the total for the page. And if we had more workers than this, then we would just have multiple pages, right? Page blank of blank. Okay. Anyway, I wanted to show you that real quick. Okay, let me get back here now. Sorry, guys, I'm clicking back and forth and everywhere here. All right. All right, so we looked at the forms for Missouri, right? The forms vary widely by state. Increasing number of states require electronic filing of the reports and electronic payment of tax liabilities. The reports required of employers by the individual states determine the employer's liability for the contributions. Amount of the contribution due on a quarterly basis, amount of benefits to which employees will be entitled if they become unemployed. Reports required of the employers by the individual states. So status reports, initial registration with state as employer liable for SUTA. That was that first Missouri form that I showed you, Missouri Division of Employment Security form that I showed you, 22, what was it? Let's go back real quick here, 2699. Contributions report, summary of the wages paid during the period and computation of tax or contribution. Wage information reports made concerning each employee, and information like earnings per employee and social security number are reported. Separation reports provides wage and employment record of separated employees and reason for them leaving. Partial unemployment notices notify state and employees who have had their hours cut back to part-time of potential eligibility for partial unemployment benefits. Record retention, every state requires that an employer maintain adequate records for each worker showing the date of hire, separation and rehire, as well as hours and dates worked and payment dates. All states have some form of penalties for failure to pay, late payment of contributions, or failure to file reports. Okay. And then real quick, I just wanted to, I think that's our last slide. Hold on one second. Let me just double check that. Just stop it. Oh, hot dog. Let me go back real quick here to my PowerPoint. I want to show you one more thing and then we'll get off here. So overall, and again, we're going to, I'm just going to put a blank slide up here real quick. They don't just have a blank slide. Well, that's okay. You know, overall, and this is one thing that we're not going to get in too much until chapter 6, but just so we understand, and I know I've kind of written something on the board similar to this before, but remember the employees, right? They have to pay 6.2% for FICA, Social Security, or what we've also been calling OASDI, right? They have to pay 1.45% for FICA, Medicare, or what we have been calling HI, right? Then they have to pay federal income tax, and then oftentimes state income tax. Okay, that's what employees have to pay. Okay, that's what they get out of their check. So when we think about it, we take, you know, their gross pay, right? We take employees' gross pay, we subtract out these taxes, and then that equals net pay, right? Okay, employers also have to pay 6.2% FICA, Social Security, right? They have to match what their employee pays in. Employers also have to pay 1.45% FICA Medicare, right? They have to match what their employees pay. But employers do not pay federal income tax. They do not pay state income tax, but they do pay FUTA, and they pay, I was getting ready to write FUTA again, hot dog, and they pay SUTA. So, you know, employees have the federal income tax, the state income tax. Employers have federal unemployment tax, state unemployment tax. So that's where, you know, kind of the overall difference between what taxes employees pay, what taxes employers pay. And this is going to come about when we look at how to record these journal entries, right? We're going to see this again when we look at recording the journal entries, because when we record the journal entry for the employee, we call this, you know, wage expense entry, right? But when we record the entry for employers, we call this a payroll tax expense. And so we're going to look at that more again in chapter 6 and get practice with those entries. Okay. Hopefully this was helpful. Again, I am going to get these PowerPoints posted so you guys have access to them as well. And as always, once you are able to read through the chapter or watch this recorded lecture, just let me know if you have any questions. Shoot me an email or see me in class, and I'll see you guys soon. Bye-bye.